Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Wealth managers are seeing an uptick in demand from Tier-2 cities. Demand in B30 or the beyond 30 cities have zoomed in the recent past. So, what's aiding this demand and what can we expect going ahead? Let's answer all of these questions. I have Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management with me. Feroz, good evening and welcome to the show. So, what's actually happening in Tier-2 and Tier-3 towns, Feroz? The demand for wealth managers over there is increasing. What exactly are investors looking for? What are they investing in?
Hi, Kavita. Like you rightly pointed out, beyond 30 cities, which is how AMFI and SEBI want to categorize them, are seeing an uptake. Point one. The reason being, I think the physical assets have disappointed. Largely, real estate over the last 8-10 years has disappointed people enormously, and I think people are becoming more and more mathematical about it. Now they're measuring the IRRs of their real estate investments, or when you start measuring using the same scale like financial instruments are measured under, then you get to know that the property which you bought might have quadrupled in 2 decades from 1 crore to 4 crores, but the IRR is sub 6-7%. So there is a paradigm shift in terms of capital allocation from physical to financial assets. That's one. Second, I think technology has made the country smaller. A person living in Mumbai or Bangalore is almost at par with respect to ease of implementation, like in a person sitting in Agra, for example. So that's the second important reason. I think third is the investor education program, which has taken a decade of a lot of effort from the regulator to the market participants to media houses like ET now. I think that's created immense awareness for mutual funds as a long-term investment tool.
Sure. I really want to understand what's the kind of investor mindset we are talking about, in terms of their risk appetite, their risk profile, the kind of schemes or the way they are investing in equity. But before that, just one thing that I observed, your frame really looks good today, especially the guitar that's there behind your frame. That's something new and that's adding a lot of color. So good to see you in a different setup. But then, yeah, coming back to the investor mindset, you think they have enough risk appetite and they understand the power of investing in equity, or maybe understanding the concept of equity, or you think it's just one euphoria that we've seen going on since the pandemic?
Look, Kavita, I think it's not interest derived out of past performance. That's the key differential between huge interests which have happened in the past, like in 2007-8, for example, before the financial crisis, the interest was driven largely by the past performance. 2006, 2005, and 2007 did so well that everybody wanted to jump in. That was basically the herd mentality. And that happened a couple of more times, like in 2017. Also, the huge retail interest, which came from even Tier-2 and Tier-3 cities back then, was driven by past performance. But this time it is very, very clear the interest has come as a collateral benefit of education and financial discipline is apparent with two key variables. I personally think last 1.5 years, barring the last two series of expiry of May and June, markets have been very subdued for a year and a half. In spite of that, SIP numbers, as you have always reported promptly, have had an uptake every single month, which I think is a clear evidence of people not buying past performance. The second evidence, very categorically specific, I would like to make, that people are far more educated now. People are buying small cap funds. If you look at the small cap as a category, has not performed for the last 1, 2, 3 years. In fact, for the last 5 years, small cap index has underperformed Nifty. And when I see retail money coming into small cap index, it's a huge positive, pleasant surprise for me. Otherwise, retailers were the last people to enter and the first to go out when the markets actually take a U-turn and go up.
Exactly. So are we also seeing the mindset shift in terms of holding on to an investment? Because you mentioned a small cap category, and usually an investor would invest in this category, even if they know how risky it is, the main intention is to have much more return and as much return as possible. So is that the kind of mindset? Are they getting into for a longer period of time?
Yes, Kavita, I think there has been a redefinition to this English word long term. I remember about 5, 7 years back, I was speaking to somebody, and if I remember right, I was in Coimbatore. And there's a person who said that I want to invest for the long term. And I said, can you please be more specific? He said, 1.5 years. And that was the definition of a tier 2 or a tier 3 city, whatever Coimbatore was called back then, in the form of long term. Now, when people say long term in these cities, we are not present in several, but we are present in about 5, 6 smaller cities. When we speak to HNI clients, when they say long term, they mean those 5, 7 years. I think that English term has been redefined to something more logical to be categorized as long term. Of course, long term should be 10, 20 years, in fact, to eternity till you need the money. But I think that's redefined as well. An English word numerically means a lot different than it used to 5 years back.
Sure. One last question quickly, and then we'll go to our viewer who's already on the phone line with us. Major investment coming from Gen Zs, millennials. How do we break this down?
I think millennials have done justice to the mutual
Okay.
fund flows, right? If you now go back to the B30, beyond 30 cities, that's why it's abbreviated as B30, is about 7.19 lakh crores of total mutual fund assets. I think if there was also a study which says millennials are doing a great job in terms of contributing to that, Gen Z are not contributing as much because they're younger lot, they little require maturity. So you're so right. Millennials are the largest contributors in tier 2 cities because the larger tickets might not be with the millennials, but ancestrally rich, which happens in metros like Mumbai and Delhi. Bangalore is still new money amongst youngsters. There's a lot more money because that's driven. The economy in Bangalore is driven by technology largely. So I think millennials are the largest contributors from the beyond 30 cities because generational money is still in real estate in smaller towns like Bhubaneswar, which I recently visited.
Right. All right. So that's the reason behind wealth managers being in demand in tier 2 cities. But then let's move on and let's connect with our viewers now. I have Mr. Nitin on phone line with me. Nitin, hi, good evening. How are you doing, sir?
I'm fine, ma'am. Good evening.
All right. I think you've mentioned the number of funds in your portfolio. You have BNP Paribas, you have Axis Large Cap, you have Mira Asset Emerging Blue Chip, you have Axis Growth Opportunity, you have Invesco Contra, SBI Small Cap, and you want to know how is this portfolio. So, any specific goal tied up to this particular portfolio that you've made?
Just wealth creation for retirement.
All right. Any specific amount for your retirement that you're looking for?
From 50 lakhs around.
50, okay, and that's all right. And this investment is not going to be a part of your regular income post-retirement. Is that right?
Yeah.
Okay. All right. Feroz.
Yes, I think, Mr. Nitin, if you've been doing SIPs of almost about 20,000 rupees a month across about 6 schemes, if 6 schemes, yes. So if you look at it being compounding at about 14% in the next 8 years, you will be able to accumulate about 35 lakhs with the SIPs you have. Of course, the time frames are 8 years, is why it's not compounding to some crores, which is what you will need for retirement. However miserly you live, I think inflation is going to catch up, and 35 lakhs for any stretch of imagination from a retirement corpus coming from the aggressive part of the portfolio may not suffice. So it requires a complete relook at what kind of quantums you will need and to make sure that you don't have to compromise on lifestyles in the latter part. When you have the time, you may not have the money. So I think please recalibrate that. And with respect to the schemes which you hold, I would request you to consider it from both the Access schemes and one Invesco scheme because we think there are better schemes from a future prospect standpoint on a risk-adjusted basis, which can form a part of your portfolio. And I'll read out a few of them, which we like to recommend to our clients. It is HDFC Flexi Cap, Aditya Birla Small Cap, ICICI Dividend Yield, Kotak Emerging Equities, Quant Active, and lastly SBI Contra. These 6 schemes will make the total to 9 schemes. I think as long as they're less than 10, you're okay. Try and spread your money, but increase your SIP would be a suggestion which I would really ask you to consider.
Feroz, how much should be the SIP amount ideally for 50 lakhs in what, almost 8 years' time now?
Yes, so I think it should be about 27,000 rupees, compounded at 14%. Of course, 14 is an assumption. You may be in for some pleasant surprise as well. I think the median return of Nifty is about 11 and a half. 2-3% extra return compounded from these set of schemes is possible. So that's why a 13 to 14% assumption. I think way India is going, I wouldn't be surprised if that's breached, but still there's a 90% chance of 14 being achieved.
All right. Mr. Nitin, is there anything else you want to ask Feroz?
No, ma'am. Okay. Thank
All
you.
right, sir. Thank you so much for sending us your question. All the best. I will take Mr. Bhoop's query. That's on email. Feroz, he would like to invest 15,000 per month in mutual funds, and the time horizon for this investment is 10 years.
Yes, Mr. Boop, if you're actually starting from a clean slate, I would like you to focus on a few categories. About 7-8 of them are very critical categories. If you spread your money in those, 15,000 is a reasonable corpus when the minimum ticket size for an SIP is as little as 500. 15 is just 30 times more than that. So I'm going to give you a laundry list of funds to make sure that you have 250 stocks in your portfolio in effect by buying these 10 schemes. DSP Equity Opportunities, Franklin India Blue Chip, HDFC Flexi Cap, HDFC Small Cap, ICICI Pru Dividend Yield, ICICI Focused Equity, Invesco India Small Cap, Kotak Emerging, Quant Active, and SBI Contra. This is a list of about 10 schemes. May seem like a large number of schemes, but 1,500 in each of them should give you a diversified portfolio. Every time you feel tempted to increase your SIP, which seldom happens with investors, please add to the same schemes and don't go beyond these 10.
And if at all he wants to increase the SIP amount, that should be divided among these schemes, right, Feroz? Because 10 schemes are anyways a lot for him to track if at all he's doing it on his own.
Yes, I think, Kavita, you're right. But what happens is if the increment is 1,000 rupees, it will be logistically difficult for him to increase the SIP of all of them by 100 rupees. So you can top up 3 SIPs at once. And the next time he has more money to put in as incremental, then he can up the rest of the SIP as well. Because 1,000 rupee extra SIP broken into 100 rupees being recalibrated into all the 10 might be a logistical nightmare if he's doing by himself.
All right, we move on to our next viewer. Surya Chandra from Pune is on phone line with me. Hi, Surya. Good evening. How are you doing today?
Hi, good evening. I'm doing good. How are you doing?
I'm doing good, thank you. You want a suggestion or recommendation on international mutual fund? Do you already have an investment portfolio that you've made, like a co-portfolio?
I do have some stocks, not taken any funds. Yeah.
Okay, okay, all right. So you've been investing in direct stocks, but then a mutual fund investment, this is going to be your first, and you want an international fund recommendation.
Correct.
All right, so let's ask Feroz. Sure. Yeah, anything else you want to ask?
Actually, I just want to know, I have few questions about these funds. What funds we can select and based on what factors, like the expense ratio, and which factors to check others about while selecting the fund, international fund.
All right, let's talk to Feroz about all of this. So Feroz, I think I somewhat know your view on international funds adding in your portfolio, but then what's your specific advice for Surya here?
Yes, Kavita, of course, like you said, you already know my view. I personally don't hold one international fund. I think that if you backtest last 20 years of holding an international fund and without an international fund, the risks measured numerically haven't changed too much. Even in the 2008 crisis, if I had international funds, I would be in the doldrums anyway, because all equities have a certain degree of linkage, especially when markets correct, all of them correct. Like if you take an example of COVID, it was not that Dow and the Nasdaqs were sitting pretty and the Nifty was falling. Right? So the whole perception that if I go international, I'm reducing your risk, as an advisor or as a client, you're reducing your risk is not mathematically provable, because when the wolves are knocking on the door, no one is spared. All the indices globally had fallen almost at the same pace. So point is, I don't like international funds because they dampen my return, but they still don't give me the risk mitigant, which they on paper definitely promise. That's point one. But if you want to go into international equity for different reasons like collecting dollars, making sure that your global goals are achieved, then definitely there is merit to have them in the portfolio. Start with a diversified fund. Don't go for a NASDAQ fund and get too flamboyant. Franklin US Opportunities Fund, which is a feeder fund, should be a good, well-diversified US equities to begin with. Then you can think of China, Korea, and all those other funds which invest in peripheral markets.
All right. So, is there anything else you want to ask, Surya?
Thanks for giving suggestion. Like I'm mostly looking for the US market.
Okay.
I mean, there are other platforms while if someone want to directly invest, like in the rare stocks through IND money.
Sure.
Any opinion on the IND money? I mean, not about the platform, but is it good to go through that other platforms, investing directly?
All right. Sure. Feroz?
Surya, I would say no for two reasons. One is people don't understand that you are using your LRS limit, liberalized remittance scheme. The kind of tax filing you have to do, I don't think most people who use these platforms on a click of a button understand the kind of difficulty you will face, the kind of incorrectness inadvertently may have when filing your taxes. I'm really worried. I don't think it gives you enough value for the kind of risks it brings to you, more regulatory risks than anything. To answer your question, go globally, buy stocks yourself on a click of a button with the help of technology. Most platforms today help you. But first, do your homework in terms of what all are you mandated by law to take care after you've gone through that exercise. Because somebody wants to give you convenience of implementation, but I don't think somebody is giving you the convenience of understanding the regulatory framework in which you do your LRS investments.
Right. All right. So more research and better homework needed over there, Surya. And with that, thank you so much, Feroz, for being on the show and helping our viewers with their financial portfolio queries today. Thank you.